One handle, two platforms. That handle is the only fingerprint they can't forge. If anyone DMs you for money, wallet addresses, VIP access, or signals, it's a scam. I sell nothing. Ever. Now drop same day in the comments if you're actually locked in, because today's tape was a stress test that exposed the entire system in one snapshot. Silver crashed 7%, while gold printed an all-time high near $5,217 on some feeds on the same day during a war. If that felt impossible, you're thinking in a calm market framework. This isn't a calm market, this is a stress market. And in a stress market, the market doesn't move like a clean story. It moves like a survival machine. Stop. This matters. Because the same day divergence is not a contradiction. It's a signal. It's the market telling you fear is real and liquidity is fragile. Gold is the trust hedge. Silver is the friction hedge. And friction doesn't move smoothly. Friction snaps. So if you've ever asked, how can gold scream all-time highs while silver gets punched in the mouth on the same day? This video is your answer, and I'm going to do it the right way. No conspiracy, no vibes, just plumbing. I'm going to show you why this happens, what it means, and the one thing you need to watch in the next 48 hours that decides whether today's silver crash was the beginning of a breakdown or the cleansing before the next squeeze leg. Now first, the environment. This isn't happening in a vacuum. Mainstream market coverage today described an escalating Middle East conflict, oil jumping sharply, stock futures slumping, and investors rushing into safe havens, pushing gold up around 3% to about $5,400 and silver up early to around $95.40 in that same risk-off move. That's the regime backdrop. The world is buying insurance. The world is repricing energy risk. The world is de-risking equities. So why is gold so clean? Because gold is the first decision humans make when they don't trust the world. Gold is the oldest I want out button. Gold is the deepest precious metal market. Gold is what institutions buy when they need a hedge that doesn't need an explanation. Gold is the trust barometer. When the world gets uglier, gold gets bought. That's wave one. Now here's the twist that breaks people's brains. Silver is not wave one. Silver is wave two. If the shock persists long enough for fear to morph into inflation, logistics, delivery stress, and scarcity psychology. And before wave two arrives, silver often becomes the battlefield where the system flushes leverage. That's why you can get a day where gold is trending higher while silver is getting chopped up. And this isn't me guessing. Financial coverage literally described that behavior today. Gold surging while silver futures declined after initial gains. Classic stress regime whipsaw. So we've established the puzzle. Gold strong, silver weak. Same day. War day, now we solve it. There are three clean reasons this happens, and you need all three or you'll keep getting trapped. Reason one, forced deleveraging. Reason two, gold-only fear. Reason three, liquidity preference. Let's hit them one by one, and I want you to actually picture what's happening inside portfolios. Reason one, forced deleveraging. In a war tape, volatility spikes fast. When volatility spikes, risk managers tighten limits. Brokers demand more collateral. Funds cut exposure. And the first assets they cut are not always the assets they dislike. They cut the assets that are most liquid and most volatile, because those positions create the most risk per dollar of collateral. Silver is exactly that. Silver is high beta. It moves harder than gold. Silver is a leveraged instrument in many portfolios via futures. So when volatility spikes, silver positions get margin pressure faster, which forces selling. That selling is not emotional. It's mechanical. It's we must reduce exposure because our risk budget is blown. And when selling is mechanical, it doesn't care about your thesis. It doesn't care that gold is ripping. It doesn't care that war is on. It cares about collateral. So silver gets hit, and once silver starts dropping, the drop itself increases volatility, which increases margin pressure, which forces more selling. That's the cascade. That's why a 7% silver dump can happen while gold is making highs. Gold is getting bought as insurance. Silver is being liquidated as collateral stress. Now stop. Here's the first trap. Most people think silver down during war, silver is broken. No. Silver down during war often means the paper market is getting cleansed. It's a sign the system is stressed enough that people are selling what they can sell, not what they want to sell. Reason two, gold-only fear. In the first wave of crisis, big money goes to gold first. Because gold is pure, silver is mixed. It has an industrial component and higher volatility. So if you're a large allocator and you need a hedge right now, you buy gold. You might hesitate on silver until you know whether this is a one-day headline or a multi-week disruption. That hesitation creates a phase where gold is bid and silver lags, or even gets sold. This is what I call gold-only fear. Gold goes up. Silver gets punished. Then, if the shock persists and turns into energy inflation and logistics stress, silver joins and can outperform violently. So the divergence is not proof the thesis is wrong, it's proof the market is still in wave one. Reason three, liquidity preference. In a crisis, the market is not trading ideas, it's trading survival. If equities are down, credit is nervous, oil is spiking, volatility is rising, someone needs cash. They raise cash by selling liquid assets. They sell winners. They sell hedges. They sell anything they can sell immediately. Silver is liquid, so silver gets dumped even if the long-term story is bullish. This is why the first wave of crisis often looks illogical. It's not illogical. It's a liquidity event. And liquidity events do not respect narratives. They respect collateral. Now here's where the video gets dangerous in a good way, because once you understand these three forces, you stop reacting emotionally. You stop saying impossible. You stop saying manipulation. You start asking the only question that matters. Was today's silver crash a breakdown or a flush? Because those are very different. And if you can tell the difference, you can stop being exit liquidity. So I'm going to give you the one behavioral indicator that decides it. This is the indicator. What happens after the slam? If silver gets slammed and stays down, buyers are absent. That's weakness. If silver gets slammed and snaps back fast, selling was mechanical and demand is waiting. That's strength. You don't need 50 indicators. You need one truth: rebound speed. Now I want to address the number in your title, 5,417s. Different feeds report different highs depending on spot versus futures versus CFD versus which contract month you're looking at. Some outlets cite continuous gold futures in the mid-5,300s during this conflict spike, while other briefs cite gold around $5,400. So if your screen printed 5,417, I'm not arguing with your screen. But here's the key point. Gold at extreme highs while silver is whipping violently is a signature of stress and fragile liquidity. Whether the exact high was 5,346, $5,400, or your 5,417 print, the regime signal is the same. The world is buying trust. The system is flushing friction. Now, why does war make this more intense? Because war is not just fear. War is logistics risk. Logistics risk is energy risk. Energy risk is inflation risk. Inflation risk is hard asset fuel. So gold gets bought immediately. But silver depends on whether the market believes the consequences will persist. If energy risk persists, silver can flip from liquidated collateral to scarcity hedge. And that flip is where silver becomes violent on the upside. So the divergence you saw today is actually a clue about where we are in the story. Gold is screaming, fear is here. Silver is screaming, liquidity is fragile. Now stop. Here's the second trap. People think the point of this video is to tell you whether silver goes up tomorrow. Wrong. The point is to tell you what kind of market you're in. Because if you're in a stress market, you can't trade it like a calm market. You can't expect smooth trends. You must expect trapdoors. Now let's talk about those trapdoors, because silver is famous for one thing. It punishes both sides. Silver punishes bulls by dropping hard enough to make them quit, then punishes bears by ripping hard enough to make them regret it. That's why silver is psychological warfare. And today's divergence is exactly how that warfare begins. Gold gives everyone confidence. Silver gives everyone pain. And pain creates the emotional decisions the market feeds on. Now I'm going to plant 3 open loops and close them, because this is how you keep retention high and keep the viewer oriented. Open loop 1, why gold can climb steadily while silver whips violently. Open loop 2, why same-day divergence often happens right before big silver moves. Open loop 3, the 48-hour checklist that tells you which path we're on. Let's close loop 1. Gold climbs steadily because it's deep, institutional, and primarily held as insurance. Silver whips violently because it's thinner, higher beta, and more exposed to forced selling. That's why you can see sessions where gold is up and stable while silver is down. Exactly the type of intraday behavior reported today. Silver declining after initial gains while gold surged. That's not random. That's structure. Now close loop 2. Why does divergence sometimes happen right before big silver moves? Because big silver moves require one thing: sellers disappearing. Sellers disappear after leverage is flushed. If you flush leverage today and the underlying stress regime persists tomorrow, the next wave of buying hits a thinner market with fewer weak hands left. That's when silver gaps. That's why a brutal red day can be the setup, if the macro pressure stays active. Not guaranteed, but structurally plausible. Now close loop 3, the watch list. But before I give it to you, I need you to hear the 3 traps that wipe people out on days like this. Trap 1, chasing silver after green candles. Gold makes highs. Silver pops for 5 minutes. People chase. Then forced selling hits and silver dumps. They panic sell at the low. Trap 2, panic selling silver after red candles. Silver drops 7%. People conclude the story is dead. Then forced selling ends and silver rebounds violently. They buy back higher. Trap 3, treating every move as permanent. In war regimes, markets reprice probability, not certainty. Premiums expand and compress fast. That's why you need a checklist, not belief. Now, here's the binary scenario map, because markets are always scenarios. Scenario A, event premium fade. Gold spikes, then fades as the market de-risks. Oil gives back gains. Silver keeps bleeding because buyers were mostly speculative. Today's silver crash becomes a larger unwind. Scenario B, stress persistence regime. Gold holds firm because fear and inflation risk remain. Oil stays elevated. Energy logistics risk stays active. Silver slams get bought faster and faster. Today's silver crash becomes a leverage flush that sets up the next leg. Now, which scenario are we in? We don't guess. We watch. Here's your 48-hour checklist. Binary, screenshot worthy, and designed to keep you from getting farmed. Test 1. Gold hold. If gold holds near these elevated levels across the next sessions, fear is persistent, not just a one-day spike. If gold fades hard, the market is de-risking the war premium. Test 2. Silver rebound speed. If silver rebounds quickly after slams, fast bounces, selling was mechanical and demand is sticky. If silver keeps bleeding and rebounds are weak, buyers aren't committed. Test 3. Oil and inflation pulse. If oil remains elevated, inflation fears stay alive and hard assets keep a bid. If oil collapses back, urgency fades and silver often cools. Test 4. Gold versus silver leadership. If gold holds and silver starts outperforming gold on up days and refuses to underperform on down days, you're transitioning from trust hedge to friction hedge. If gold holds and silver continues to lag, we're still in gold-only fear. Test 5. Volatility signature. If you keep seeing violent intraday swings, silver up early then down later, this is consistent with thin liquidity and ongoing positioning cleanse. That means the market is still cleansing leverage. Now stop. Here's the line that ties the whole video together. Today wasn't silver failing. Today was silver showing you collateral stress. Gold is the safe haven destination. Silver is the battlefield where the system flushes leverage. That's why the same day divergence is one of the most important signals you can get in a war regime, because it tells you whether we're still in wave 1, gold-only fear, or transitioning into wave 2, hard asset repricing and friction. Now I'm going to make this emotionally clear because this is where viewers either stay or click away. If you're the average person today, here's what you felt. War headlines, gold at new highs. You thought, finally, the hedge works. Then silver down hard and your brain screamed manipulation or it's over. Right there, right in that emotional spike is where the market farms people, because emotional certainty creates bad timing. So I'm telling you, this divergence is not a glitch. It's a feature. It's how the market cleanses weak hands under stress. Now, the honesty wedge, because credibility matters. Sometimes a silver crash is just a crash. Sometimes it signals real weakening demand. That's why we rely on behavior after the slam. If silver can't bounce, that's weakness. If silver rebounds fast, that's mechanical selling ending. That's how you stay honest. That's how you stay alive. Now here's the final cliffhanger, and it decides everything. When the next silver slam hits, does it get bought like a hedge or dumped like a trade? Because that one behavioral answer tells you whether today was a breakdown or the setup for the squeeze phase people only understand after it's already too late. This isn't financial advice, this is financial warfare education. Drop same day if you want me to map the next 48 hours using the checklist. No hype, just structure.